So understanding credit for buying a home. Credit is a very, very, very important aspect of financing when you're talking about, especially purchasing a home. Since 2006, I have pulled and reviewed thousands and thousands and thousands of credit reports, helped countless people either establish credit, build up their credit, fix it, or simply just improve their scores so that they could get access to better interest rates or loan programs for the benefit of a lower monthly payment or a higher pre-approval amount. And so the purpose of this is really to kind of share with you what a lot of us didn't learn before. It seems like in middle school and high school, if I think back, I clearly remember sewing pillowcases and aprons. I remember taking care of a hard-boiled egg. And it's interesting because to date, I don't know that I've actually ever sewed anything after high school. And the only time I've ever hard-boiled an egg was ultimately to eat it. So those really didn't, I don't think served a whole big purpose, at least for me. My introduction to credit was, walking across the drill field at Virginia Tech. They had tables set up and you could go fill out a credit application in exchange for a t-shirt. And then once you had that credit card in your possession, there was plenty of places to swipe it, and then the bill would come and you're kind of starting off behind the eight ball. So the purpose of this video is really to kind of help you understand how credit works, generally speaking, and as it pertains to purchasing a home. So the first step is knowing that when you're talking about purchasing a home and the credit report, we're talking about a residential mortgage credit report or an RMCR. And that's going to be extremely important because especially nowadays, it seems like every credit card company, every financial institution, they all have a link on their page where you can click and go see your credit score. There's a couple, I won't use their names, but there's a couple big apps that, or popular apps, I should say, that you can, with a couple clicks on your phone can download to your phone. And again, you have your credit report all for free. And it's important to understand that all these different credit, tools that you have available to you, they're all a lot of them are using different variations of scoring models. So a few of them I've seen are on completely different scoring scales than a residential mortgage credit report. But the important part to note is that anytime a bank is pulling your credit for the purpose of a mortgage transaction, we're all going to be looking at this particular type of report, this residential mortgage credit report, and therefore our scores are all going to be the same. So if you're looking at your app on your phone and you say, hey, I got a 680 credit score, and then we look at your credit on this residential mortgage credit report, you don't want to be surprised by, if you're seeing 680 on your end, we may see 700 or we may see 620. So it just really has to do with the type of report that we're actually looking at. Okay. So when you're talking about a residential mortgage credit report, it's the scores are coming from all of the three main credit bureaus, Experian, Equifax, and TransUnion. And within that, those three scores, we're always going to take the middle score of the individual for qualifying. So you'll have a high score, you'll have a low score, and then it's in the middle. Sometimes that range will be pretty significant, 100 points between the high and the low. Sometimes it'll just be a handful, but it always is going to go off of the middle score. So anything over 800, which it seems like a lot of people strive for, and it's a good goal to have. Anything over 800, I would consider excellent. You're going to have access to pretty much any credit program available or any financing program available over 800 for sure. Now, the credit part you would qualify for. There may be some other stipulations that would be requirements to do those programs. But again, we're just talking about the credit side. So at 800, you would qualify for everything. At 740 to 799, again, I would consider this high credit. In this category, you're going to qualify for 99% of the programs out there when you're looking at it from a credit perspective. I'm sure maybe somebody may point out, well, no, with this program, you need a 760. Okay, fine. 740, 799, you're still very well qualified from a credit score perspective. The next category I would kind of separate out is going to be good. So this is going to put you between 670 and 739 in this range. Again, you're going to have access to most programs. You will start to see a significant difference I shouldn't say significant. You will start to see a noticeable difference on things like maybe rates and maybe some of the closing costs. Some of your program options may start to decrease. But as far as with the ability to purchase a home between 670 and 739, you're still in a pretty good position. Now, between 580 and 669, this is a relatively speaking broad range for this category because a lot of programs will require a minimum of 640 or 620 or 600 or 580. Generally, things move in 20-point increments, but there's a lot that's captured in this particular range. But it's also significant because, again, you may meet the credit score requirement, but it doesn't guarantee an approval in this category. But the really good thing about really all of these categories, but in particular this one, is we're not too far off from where we need to be for many of the options. And a lot of the institutions that can provide you with a credit report can also provide you with like a credit simulator or credit analyzer tools that can help get you into some of those higher credit brackets so that you have a better chance or so that you can qualify to purchase a home. But what starts to happen between this 580 and 669 range is a lot of people assume they just don't qualify and will not even pursue it if it is something that they would ultimately like to do. So again, 580, 669, it's not a terrible score, but in many cases, there may be some action items that need to be taken. And then finally, below 580, you're definitely on the lower end of the spectrum. And again, it's not impossible, but it's going to come with definitely some stipulations, which we may need to take, or we may need to kind of extend our timeline out so that we can up the credit a little bit. For example, some of the programs that are out there, they'll let you go below 580, but instead of maybe doing a 3.5% down payment, you got to do a 10% down payment. Or you may have to show quite a bit of documentation to show that you do have the ability to repay. But for the most part, this is going to be a pretty standard score range for categories when we're looking at purchasing a home. So how scores are calculated. This is probably one of the most important parts, is understanding how the score is calculated. So when you're looking at a credit score, you have these different percentages. And this, again, based on a residential mortgage credit report. Okay, about 10% is going to be your credit mix. What type of accounts do you have? Do you have a good mix of installment, which are accounts that you take out, a one-time balance, you pay them off. Most commonly, that would be something like a car loan. Very easy to understand. You take out $25,000 for a car loan. You make a set monthly payment every single month. The balance goes down. If you want to get a new car, ideally, you would pay that loan off, and then you go purchase a new car and get a new loan and do it again. So that's going to be like an installment loan, or, another example would be like a personal loan or like a debt consolidation loan, where again, you're taking out a fixed amount. You have a fixed set of payments as standard every single month until the account is paid off. You also have things like revolving accounts. So that's more commonly known as like a credit card, where, you have a limit. And your payment is based on the outstanding balance. So, you get a credit card with a $1,000 limit, and, you can charge as much as you want until you get to that 1,000. Let's say you get close to 1,000 and you make a $500 payment. Fantastic. Now you have another $500 that you can go charge on that card before you start, before it gets declined. So, installment versus revolving, auto loans, if you have other mortgages, if you have credit cards, personal loans, all of that goes into its credit mix, which again is going to be about 10% of your score. Length of credit history. How long have you had established credit for? Are we talking, you don't have a history and we got to build your credit? All things being equal, clean payment history for 6 months after opening an account, not necessarily going to have as high a score as if you've had credit for the last 20 years. With a clean payment history. That's going to make up about 15% of your score. Again, this is why, a lot of times you'll hear people say, don't close accounts. If you close your accounts, scores will drop. We'll go into a little bit more detail, but that's kind of the general premise of that statement. New accounts. Do you have the new accounts? That's going to account for 10%. If you have a ton of new accounts, you're probably going to have a lower score, which again, we'll talk about here in a second, but that is part of the weight on a residential mortgage credit report. 30% is going to be this utilization. So jumping back to that credit mix, we were talking about revolving accounts or credit accounts. So you have a limit, $1,000. If your balance on that $1,000 card is $999, you will have a lower credit score than if it was at 10% of the limit, which would be, $100. That utilization is key. And in most cases, when we're in a situation where we're trying to help people, make some quick increases to the credit score, that credit utilization is going to be key. And then the last piece is going to be payment history. So on payment history, this is kind of one of those things where sort of what's done is done. If you fall into the category, extreme example, you spent the last 20 years never paying anything on time. It's going to take a lot more work to up that score than, if you had a couple blips or if you have a clean payment history. And again, life happens. Sometimes there's just, nothing you can do. But the important piece is that pattern and how far away you are from those recent events. It's also really important to know, and I didn't know this when I took out my first auto loan. Your payment history, when you're talking about reported lates, you're talking about 30-day lates. You're not talking about my payment was due on Friday, I forgot to make it and I paid it on Monday. We're talking about 30-day late. So you would have to miss 4 Mondays before you have a 30-day late. So that's what they're going after when you're talking about payment history. So new credit and credit mix. So, a couple things that you want to keep in mind if you're trying to maximize your score. Sorry for jumping that slide. Try to avoid opening a multiple accounts in a short period of time. So new accounts often come with inquiries, and it's a very common misconception, at least in the way it's presented to me in terms of a question is, I don't want to have any inquiries. I don't want you to run my credit. So, if you're opening multiple accounts within a short period of time or a short window, every time you open up an account, somebody's going to want to run your credit. Okay. So over time, if you go to Macy's and have them, run a credit, and then you go to Target and have them run credit, and then you want to go get a car loan and have them run credit, and then you're out trying to do a debt consolidation loan, so you go to Discover and have them run credit, that's going to be a situation where, you're going to be considered a high risk because you're out running credit for all different, reasons. And, I see this not a whole lot recently, but I've seen it, definitely for periods of time in the past where it seems like everybody's going out and purchasing a house full of furniture on credit because, 0 interest, same as cash for 12 months or, whatever the case may be. Those are our inquiries. That's going to end up impacting your score. Oftentimes, when you open up a bunch of new accounts, now your average age of account starts to drop. And so then your score is impacted. And then again, like I mentioned, you're considered high risk with that activity. And it's also important to note, that, it's not an individual sitting down with a pencil and paper trying to calculate a score. This is just a computer system, computer software with embedded algorithms that kind of does all of the legwork in terms of the score. So definitely keep that, term higher credit risk. That's definitely a relative term. Okay. Ideally, again, you'd want to have a good mix of accounts, so a good mix of installment, good mix of revolving, and 3 trade lines. So a trade line is just 3 accounts reporting in your credit. Now, some people just are very adverse to credit, and there's nothing wrong with that, because there are alternatives that you can look at, and have those manually added to your account. But ideally, when you're talking about the mortgage process and credit, you want to see 3 trade lines for a 12-month period. So credit utilization. So going into a little bit more detail on that. Again, this is when I say simplest and fastest, I use those 2 terms loosely because, when you're talking about paying down accounts, obviously the money has to come from somewhere. I know people don't have money trees out in their backyard that they can just go pick off a few thousand and put towards these balances to help immediately fix a credit. But it's the thing that you, I guess, have the most control over. So here's an example of credit utilization. So you have 2 charge accounts, doesn't matter what they are, but 2 credit card accounts, account A and account B. Account A has a credit limit of $1,000. Your balance is $1,000. So your utilization on this account is 100%. Okay. That should make pretty straightforward sense. Account B. Okay, credit limit $9,000, balance is 0. Utilization on this account is 0. So overall, on account A, your score might get dinged a little bit just because you do have that maxed out account, but that should be offset by account B, which has a 0% utilization. So in the overall credit profile, your available revolving credit is 90% or a 10% utilization, because you have 10,000 available to you, you're only using 1,000. Okay. Now, sometimes you'll hear people say, okay, well, don't close accounts, it hurts your credit. And that is 100% true, because if in this situation or this scenario, you come in here and you close account B because you're not using it, your utilization just went from 10% to 100%. And now your credit score, I don't know if I'd use the terms as strong as tank, but you will see your credit score drop if that was to occur. So what you want to try to avoid doing is definitely before you're looking, right before as you're preparing to get ready to apply or purchase a loan or purchase a home and apply for financing, you do not want to go in and close accounts. Also, when you close accounts, you end up shortening your average age of accounts again. And so that's something that you want to try to avoid if you're trying to maximize your credit score. One of the things that I found interesting, and it makes total sense, is, again, let's say you have these 2 scenarios. You have somebody who's not using a credit card at all. You do want to keep activity on your account, because after a period of time, the creditor can actually close your credit account due to inactivity. And that's a lot of times something people don't realize, that, if you have this account that you haven't used for a year, it has a 0 balance, it's been a 0 balance, you may get a letter in the mail one day that just says, hey, your account's been closed. So it's always good to kind of use and maintain a small balance. And actually, in many cases, having a small balance is better than having no balance, because the way the computer system is reading your credit score, if you're actively managing your debt, you use it $100, $200 a month, and then you pay it down, and then you use it again, and then you pay it down. You're exercising, I guess, what I would call financial responsibility, as opposed to somebody who just has it but doesn't use it. There's really no track record of being able to manage and maintain the account. So you, in many cases, actually pick up more points by having a small balance. A lot of people say keep the balance below 30%. I've noticed most of the time running credit analyzers that it typically wants your balance be closer to 20 or 10%. But the key thing is don't max it out, and for sure keep it below 50% whenever possible. Okay. this credit utilization is so important. There's a scenario I had a few years ago. Actually, it's probably about 10 years ago now. I was working with the veteran, and the guy didn't have any charge accounts. He just had his car loan, and that was it. And he didn't have a terrible score, but all things considered, but he was missing a significant part of that credit profile, and that was the revolving account. So one of the things that I had mentioned to him, he wanted to do a VA loan, which is cool. Actually, I take that back. They're a great loan product. But the fact that that's what he wanted to do, cool, made perfect sense. Is what I would do. Wanted to apply, but his credit score was not quite where we needed it to be because he didn't have an account history or any credit history. All he had was a car that he had just purchased like 6 months before. And so I had told him, I said, hey, man, you need to go open up a credit card. That way we can help you get this financing. I told him, get a secure card. I'll go into more details to how all that works in a little bit. But I told him get a secure card, just put like $20 on it, and then let your statement close. We'll run your credit again, and your score should go up. This was a new construction transaction, so we definitely had time. So it wasn't like super urgent. So in that case, he was hesitant. He didn't want to do it. He said, I don't really want to pay interest if I don't have to for stuff. And, I kind of told him, I said, well, you're more than welcome to go get a second opinion. But based on my understanding of the market and what's going on, you're probably going to run into the same issue. So he was like, all right, well, that doesn't make sense, whatever. So he ended up going out, trying to get approved at actually two more banks, and both of them said no. But the good thing is that none of them, well, good thing for me was that none of them told him what he needed to do. So he ended up coming back to me and saying, hey, yeah, I tried to apply. They said they couldn't do it. My credit score wasn't where it needed to be. I said, okay, great. Let's do the card. I said, worst case scenario, you go, you get a secure card, you have an account, but we can get you this house. Worst case scenario, you have a card, you can close it, and you don't have a house. So, I mean, your only alternatives here is an upside based on your current position. So he ended up doing it. We waited about 40 days. He went ahead and started using it. It reported his credit score went up about 80 points and just under or just over a month. So that 30% when you're talking about credit utilization is huge. So definitely, if you fall into that category, you have questions or whatnot, shoot me a message and I'll be more than happy to help. Okay. So again, coming back to this overall utilization on this combined scenario, 10%. If you close this account B out, your utilization automatically goes to 100% instantly. And now your credit starts to go in the wrong direction. Okay. So payment history. Again, we have mentioned before, payment history is kind of one of those things where what's done is done. You can't really go back and change, how your accounts are reported without quite a bit of legwork. Okay. But typically, again, life happens sometimes, things fall behind, but it's important to realize what reports and what doesn't report. Generally speaking, if you're supplying a social security number, address, and name and date of birth, you're probably going to be reported to the credit bureaus for payment history, with the exception of utilities, which obviously gas, electric, water, trash or waste removal, cell phones, that's not reported. Internet cables, not reported. Car insurance isn't reported. And typically neither is rent. Now, these apps on your phone, coming back to these apps on the phone, yes, they do have the ability sometimes where you can log into those apps and have some of these items added to your credit report. And as long as they have a clean payment history on them, it should improve your score. But generally speaking, these do not report into your credit until they go to collections. Okay. Once these accounts go to collections, now we have a whole new situation that we need to deal with, talk about, and understand. So When you're talking about collections and charge-offs, those are two main categories for basically accounts that are in default. So what is a collection, and how does it actually impact your score? So when an account falls behind and it's sold to a debt buyer, what happens is let's say you have an car insurance that you just didn't pay. And normally they're not reporting to the credit bureaus, but you stop paying, so now they report it as a collection account. What ultimately is happening is, let's say you're behind $1,000. Okay. If you're behind 1,000, they may sell it to a debt buyer or a debt collector. You can use those interchangeably. They sell it to a debt collector for this $1,000 account. They may sell it to them for $150, something relatively low to the balance. Okay, so what happens is now that debt collector or debt buyer is likely going to try to make attempts to collect on the debt under the premise of, yes, you are aware that you owe this insurance company $1,000, you defaulted, so they're going to try to collect at minimum the amount that they bought it for plus some margin. Okay, so if they spent 150, ideally they want to make at least 150 or collect 150 from you. But anything over that 150, they are essentially turning a profit. Okay, but the key distinction, at least in the type of account between collection and charge off, is going to be the collections actively being sought after by this debt collector. Okay, now how it impacts your credit. So there's two pieces. One, obviously, the presence of the collection will hurt you, but the last report to date is going to be important. The last reported date. So on a fresh collection, if it's reporting as current, as in, if it's January 2024 right now, and it's reporting as January 2024 now, that is what's impacting your score, not the balance, not the amount of the balance, and not whether or not it's a high amount or if it's actually zero and paid. Okay, it's the date that it last reported. So, for example, if you're in a situation where you have this outstanding debt of $1,000, whether you paid the full 1,000 or if you paid the 200 that you negotiated, just by paying a collection, in the vast majority of cases, that will not inherently improve your score. But what would likely happen is the sooner you pay it, the more likely that account will stop reporting as current, and then your score will start to gradually go up over time. Okay. Now, with a charge-off is a little bit different, because this is where the creditor just writes it off as a bad debt and just says, we're never going to be able to collect. They'll put it on your credit that you didn't pay it, but it is not actively being sought after, and it's been written off. So a charge-off will have a balance until it is paid, but it is not going to be actively collected. So in this case, the credit is no longer pursuing payment on the account, and its presence and the balance actually impacts the score. So if you're looking at, let's say you have a charge-off account for $400. Okay, that $400, the fact that you have that balance there is what's hurting the score, not necessarily the report date as much. But as soon as you pay that balance within the next reporting cycle, once that balance is updated, then it would go to zero. Okay. Now, fortunately or unfortunately for me, I have another real life scenario for this. So before I gave you the example of the credit card, so this is a real life personal situation where a few years ago I had purchased an HVAC system. I had the guy come out, he did his estimate, gave me a price, also mentioned rebates that I would qualify for if I bought certain units, and had them put them in. So I agreed on an amount. It was a $12,000 system. There was, I believe it was like $4,000 in rebates. So I would ultimately owed $8,000 for this system, which at the time seemed like a good idea. Don't know a whole lot about HVAC, but compared to what I was also being told by other companies that had come out and done some estimates, it was a pretty good deal. Okay. So they did the work. They installed the equipment. I asked for the rebate information a few times, never got it. My first bill shows up in the mail showing my original balance, the 12,000. I was a little upset and irritated. Tried to get a hold of my sales guy. He didn't respond. He stopped answering texts, phone calls, and emails. So I got in contact with his manager. He pulled my file, looked at it, and said, "Oh, well, it looks like you didn't purchase a thermostat, so you were not eligible." So I asked him, I said, "Hey, listen, if I had to spend $100 for a thermostat to save $4,000 on this system, I think you and I both agree that that's a no-brainer. I wasn't told I need to purchase it, but I will buy it right now so I can do it, or so that I could get these rebates." So he said, "Okay, that's fine." He looked it up. I had to chase him down. Eventually, once I got him on the phone, he ultimately told me that, well, unfortunately, with the combination of units or pieces to the unit that I got, I would only be eligible for about 1,000, not 4,000. So at that point, I was pretty upset. Didn't feel like dealing with those people anymore. So I made my payment on the system for a couple months, and then after that, I was just thinking to myself, I said, you know what? I got a nice house. I got, a relatively new car. I don't need credit for any reason. So I stopped paying it. And of course, the phone calls started coming in. They said, "Hey, you need to send this money. We're going to report it late," which they had already been reporting late. I was fine. I was watching my score go down, but that I was more out of principle. I was taking this stance. So I stopped making the payments on it. I told him, "Yeah, that's cool. I'm not paying this amount. This is the amount that I'm willing to pay once everything gets updated. I was misled. Here's all the documentation I had that led me to believe it was an $8,000 balance." And they refused to fix it. So they sent the account to collections. So shortly after that, collection company starts contacting me. And I was in a situation where I explained everything to them. I didn't really care about my score at the time. This was a matter of principle. And so I told them the same thing, and that once they were willing to send me something in writing, which is key, in writing, that the negotiated terms, what they would be, and that it would be deleted from my credit report, since now I had these late payments and collections on there, then I would go ahead and send payments in. It took about 3 months of back and forth, but eventually they sent me an agreement, and then I fulfilled it, and that account is completely gone off of my account, as if it never existed. So yes, they can be removed. I've done it personally. It takes time. It takes patience. You probably got to be a little bit stubborn, and unfortunately, I feel like in this case, sometimes a little bit of aggression is needed, but it can be done. You may call and ask for something like this to be done. A lot of times, it's termed a pay for deletion is the key word that a lot of people throw around when talking to creditors. But I've heard a lot of times that they'll say, "Oh, well, as a creditor, we have to report it. It's illegal for us to not." Well, if there's actual grounds for the collections or for the charge-offs to not be accurate, so that there was some dispute, some disagreement, or let's just say it is completely fraudulent, it can be removed. But again, it's just going to take time and patience. So that's something that you can do, or you can enlist the help of a credit repair company. They can oftentimes help, as long as it's a reputable one, and you have a good agent working on your behalf. Okay. So important points about credit. So, and talking about credit, having the right score does not guarantee approval. And this is extremely important. When you're talking about purchasing a home, credit is just one aspect. There's other items that we have to take into account, obviously the income and how that relates to current monthly obligations with the proposed mortgage payment. You have to take into account assets, where money is coming from, and if it can be documented. So just the credit score alone is not sufficient in qualifying, but it's one piece. But the good thing is that you do have some control over adjusting it if you need to. Late payments, bankruptcies, foreclosures, these items do not automatically disqualify you from homeownership. Okay, and on this one, I do got to go into a little bit of detail because there's a lot of misconceptions about, the bankruptcy and foreclosure piece. Okay, so with bankruptcy, the bankruptcy, whether it's a Chapter 7 or Chapter 13, there's different rules and seasoning requirements as to how you can qualify to purchase a home. But it gets interesting when there's a mortgage included in the bankruptcy. Because if there's a mortgage that's included in the bankruptcy, that is not the same as a foreclosure. Okay. With including your mortgage in the bankruptcy, all that does is it basically tells your creditor that they cannot actively collect this debt anymore. And once in this case, you're not collecting, or the bank is not collecting on the mortgage payment, they have the right, according to the deed of trust, deed documents, to foreclose on the property. And they, unfortunately, in many cases, do it at their discretion on their own timeline. And so what happened is you may file a bankruptcy in 2024, but the foreclosure does not actually occur, which would be marked by the bank repossessing the property or taking the deed out of your name and then reselling it into someone else's name, or reselling it and then the deed going into someone else's name. That is when the foreclosure is complete and when the seasoning or waiting period requirements begin for the foreclosure side. So the bankruptcy just basically sent notification and said, hey, you're no longer allowed to collect on this debt. And the foreclosure is the actual execution of repossessing and reselling that property. Okay. So although having a bankruptcy or foreclosure definitely makes it a little bit more challenging. I've done plenty of these transactions in the past. If you're in the Chapter 13, you can actually be in the 13 while you purchase a home. Again, you just need extra paperwork and some documentations and to meet some additional requirements, but it does not automatically disqualify you from home ownership. And then credit can be established, okay, or credit can be reestablished. So if you go through one of these significant events of a foreclosure, of a bankruptcy, or let's just say, again, life happens. It happens to all of us at different stages of our life. If life happens, it is not the end all be all. Okay. Your credit can be established. And especially after a bankruptcy, one of the first things you really need to do is consider that reestablishment. And the easiest way to get that process started is through the use of a secured credit card. Okay. And so what a secure credit card is, and again, if you've gone through something as significant as a foreclosure, I 100% recognize the last thing you probably want to do is go take on new debt. But it's vitally important to being able to have, rebuilding your credit score. So with a secure credit card, that's basically you go to your bank. Typically, it's where you got your direct deposit or where you do your banking out of. And you're giving them money. You give them $500 or $1,000 or $200. Just give them a agreed upon amount up front, and then they issue you a credit card that you want to make sure is reported to the credit bureaus. And essentially, you have the ability to charge up to what you give them. Now, a lot of people say when I explain this to them, okay, well, that sounds silly. Why then I'm paying interest on my own money? And yes, that is true. You are paying interest at your own money, but for the benefit of reestablishing your credit faster than you otherwise would. Because again, remember that available revolving credit accounts for 30% of your score, almost as much as your payment history. So it's really important to kind of start that track record and start building that history of clean payments again. So getting that secure credit card is key. Now, remember, with the secure credit card, as with any credit card, available revolving credit is 30%. So if you have a $500 limit, you don't really want your balance going too far over $50 anyway. And, the interest on $50, at least at, a 30% interest rate, let's just say a super ugly card, 30% interest on $50, relatively speaking, is not very much, again, at the cost of reestablishing credit. Because if you enter into a mortgage transaction at some of these lower credit scores, 580, 6 up to 600, you're going to be paying a lot more interest on those purchases than the interest would end up paying on a $50 to reestablish your account. So again, reestablishing credit is key. So again, when you're talking about purchasing a home, there's definitely a lot of ins and outs. When you're talking about the credit score, it's always important just make sure you're dealing with a, hopefully responsible and responsive mortgage professional. That way they can kind of give you accurate idea as to what's going on. If you do need an action plan, give you an action plan that's actually going to be effective and based on, ultimate goals that you have. So if you do have any additional questions, feel free. You can leave them in the comments. You can reach out to me. I'll have all my contact information in the comments as well. But I appreciate your time and joining, and I hope that you had some good takeaways from this information about credit.